What's up, my people? This is Global Forex, and guys, I welcome you to the Inside Empire. This is where theory meets practice, and of course, we are number one Forex mentor and coach, Global Forex. Now, talking about the Forex market, we have basically so many ways to analyze the Forex market. We have pure price action traders. You will hear traders talking about double top, double bottom. We have traders who technically rely on what we call the technical indicators. You will hear them talking about moving averages, MACDs, relative vigor index, Ichimoku, and other technical indicators. And we have another category of traders called the smart money traders. And now, what the smart money traders do is that they try to imitate or they try to follow the footprints of institutional trading, right? Because basically in the Forex market, we have various market participants, and among the various market participants, we classify them into retail and institutions. Right now, institutions, these are those big market participants who has significant volumes, or trade significant volumes that has an impact to the Forex market. Example are central banks and such. Now, when you are following the footprints of this particular institutions, you are supposed to trade basically following specific points of interest that we call the institutional reference points. And basically, we have 7 institutional reference points. So in this particular video series, I'll be introducing you to ICT Smart Money. ICT is a development of Michael Hanson, and so we are doing I'm just trying to simplify what he taught for you, so that you can be able to understand how ICT trading works, because it's one of the super models that you can be able to adopt when you are trading in the Forex market. Now, talking about the smart money concepts, the ICT smart money concepts, we talk of the 7 institutional reference points, where we have them arranged in the order of order blocks, fair value gaps, we have mitigation blocks, we have breaker blocks, we have rejection blocks, we have liquidity void, and then the last ones are basically the order highs and order lows. These are among the 7 institutional reference points. Now today, in this particular video, I'm going to explain to you how order blocks work, what is an order block, and how to trade using the order block. So the best trading strategy that you can be adopt when you are trading using the order blocks. All right, so without much ado, let's dive to the charts and see what an order block is. All right, now an order block basically is an institutional reference point, which is anchored on the idea that smart money do not activate all their orders at the same time. So they always activate some partial orders and then leave some pending orders lying within either a demand zone or a supply zone, and that is basically what we adopt as our points of interest. So arguably, an order block is always the last corresponding candlestick to print before an impulsive move, either to the downside or to the upside. And we have the characteristics, or we have the qualities of an order block that is actually valid, because as you know, guys, not every order block works, and that comes to the argument that so many people, especially Forex beginners, they always execute trades from the order blocks, but then they always get caught out of the market. It always, most of the time, plays against their overall bias. So today we're exploring what makes the market to play against their overall bias. Why is it that some of the other order blocks that most the beginners spot are not able to work for them? And today we'll be talking about the characteristics of order blocks that work, and then I'm going to show you how to spot a valid order block. All right, now this is it. An order block, basically, we say in a 3 candlestick price action. All right, let's assume we have a movement to the downside. Trying to draw something here. Movement, assuming these are candlesticks. All right, and of course we can have our candlestick being blessed enough to have wicks. Nice one. So these are bearish candlesticks, for example, or whatever I'm trying to draw is an illustration of a bearish candlestick. This is basically what we call an order block. So from where this last bearish candle prints, Then we have a market move to the upside, all right, and this time around with some impacts in this manner. All right, whatever the market did, it continued to go up. All right, so it was an attempt to drop at this particular point. Nice one. Now this last red candle to print here before an impulsive move to the upside. Of course, the impulsive move should lead to something we call a break of structure or a change of character. So that is the first characteristic of a valid order block. It should have what we call a break of structure or a change of character, right? So this is structure being broken to the upside, and then this last red candle to print over here is what we mark out as our order block. That is what we mark out as our order block. And the idea beyond trading an order block is that the market should come back to the order block. The market should come back to the order block, and that is where you are supposed to pick your entries from for buys. So this is the basic idea beyond trading a traditional order block. All right, so this is the idea behind trading a traditional order block. So this is why you're supposed to go for a long position, having a stop loss just below your point of interest, and then probably you target the previous high, and it will give you around 1:3 risk to reward ratio, which is pretty nice trade. So this is the idea behind trading order blocks. And one thing we like about trading the smart money concepts is that when you're trading the smart money concepts, or specifically the ICT concepts, because the trading is based on specific points of interest, like an order block, a fair value gap, or whatever it is, once the market trades below your point of interest, you don't have any other business engaging that particular market in the same direction. So this makes it very easier for you to be able to have a good risk to reward ratio, or knowing whenever my order block plays out, I'm supposed to click, let's say, 3 times what I had set aside as my risk. So for example, if you are risking $100 for this account, as you can see, we have 1:3 risk to reward ratio. So this means if you risk $100, you should secure at least $300 in profit. If you risk $1,000, probably you are getting $3,000 in profit. So at least this can give you a good way of ascertaining your risk to reward ratio, because as you can see, we are looking at a specific zone. Unlike when you're using the technical indicators, for example, there were those indicators, those we are trading when we began trading the indicators that we are crossing over. Once they cross over, we buy. Once they cross over, we sell. So it becomes very difficult for you to ascertain why exactly are you putting a stop loss, because you do not have an exact point of interest for you to be able to trade from. So today I'm going to show you the indicators that work, because I don't want you to struggle looking for these particular indicators. So it's very simple. Everything is modern and simplified for you. So if you want to get these indicators, or not indicators but technical order block where there's located in the forex market, you need to come here to the indicators tab and search order block detector. Search order block detector. You are not supposed to struggle in anything when you are trading. Simplify it to work for you. Order block detector by Lux Algo. Right, order block detector by Lux Algo. Here's a space. Just a minute. Order block detector by Lux Algo. This one. All right. By Lux Algo. You put it like that. It will set for you anywhere where we have order blocks. So for example, you can see here we have a bearish order block. I think this is a big time frame order block from where it was, and once the market tapped it, as you can see, it tried to sell from that particular end. And as you can see, we have currently printed a bullish order block. This last red candle to print over here, it's a bullish order block. So this means once the market comes to that particular zone, we are just going to pick an entry from there and probably target the previous high. And let's see what we'll be risking for this particular trade. If you go long position there, you will have just yourself having a stop loss over there and probably target the previous high at that particular point, and as you can see, this is about 1:3 risk to reward ratio, which is actually a pretty fine entry for you to make. So always try to attempt to enter from these particular zones, because these order blocks are actually one of the most powerful institutional reference points and the best ways to trade. So in the next episode, I'm gonna be explaining to you order blocks that has a high probability of working, why we trade from some order blocks, and why sometimes we choose to disregard others. And I'm gonna do a series of all the smart money concepts in detail. So click the link on my bio so that you can also be able to access our live sessions, because most of the time we come live trading maybe on Instagram and also here on YouTube, so that you can be able to get advantage of all that. And in that particular Telegram, I also share my insights on what I think the market is likely to play out, and so these are some of the things, or these are some of the materials you can be able to leverage on when you are trading to scale it up. Attached below also is a link to one of the best brokers that I could propose you use, because of availability of so many wrong brokers. Remember, the broker you are using also determines whether you're going to be profitable or not. So tap those links, get started, and also remember to like and subscribe to this particular YouTube channel, because by doing so you motivate me to do more and more content to be able to help you in your trading journey. For now, it's a goodbye.